Jeni Browne. Welcome to this week's edition of MFB News, or should I say bonjour. Thank you so much to everyone who left kind messages last week. It's actually really nice to read them, and we do genuinely appreciate them. I had a lovely trip to Paris, thank you. Shame to ruin it by coming home, really, isn't it? Now, also, what we're seeing is some really kind of interesting comments on the video with regards to your views on various proposed changes from the manifestos that are being published at the moment. Do keep them coming, actually. It's really, really interesting, not just for us, but for other people who read the comments, to see where different people's viewpoints are on things. So we do appreciate you leaving those. Now, in terms of what we've got for you this week, we're going to talk about swap rates, what's been happening with those. We're going to give you a sort of longer term view on what's going to be happening with interest rates. So today, it's Wednesday morning, cracker sparrows. I'm afraid it's very, very early, so we don't yet have the inflation news that's due out today. But we are going to be then seeing the MPC meeting tomorrow on Thursday. So we're going to give you a view on what we think is going to be happening there and in the longer term. We're going to talk a bit about rental calculations. That's been something that's been causing some real headaches for landlords, where the interest rates have increased and the rental calculations have followed suit. Making the numbers stack up in terms of rental calculations has proved quite challenging. So there's been some movement there. We're going to talk a bit about that. We're also going to talk about the Reform Party, something I probably thought I'd never find myself saying, and some of the commentary that they have released with regards to their manifesto for any potential leadership as well. So lots of great content for you today. Okay, so first up, we're going to start off with the favourite subject of swap rates, and actually things are a bit better than they were last week and indeed over the last few weeks. So as of 10:30 Tuesday evening, 2-year swap rates are 4.484. 1 month ago, 4.486, so basically the same. And 1 year ago, 5.557, so 0.7% lower than they were this time last year. And more positively, I know psychologically I like to see, or I've been kind of really hoping for 5-year swap rates to come below 4%, and they're kind of hovering, broadly speaking, around the 4% mark. As of last night, 3.912. 1 month ago, 3.968, and 1 year ago, 4.926. So again, sort of circa 0.7% higher 1 year ago. So actually, we are on Wednesday morning in a better place than we were not just a year ago, but also 1 week ago. Let's hope that continues, but we'll just have to wait and see. Now, in terms of what's been happening with the lender pricing changing in the last week, we have seen a few reductions, nothing to kind of get too excited about, but reductions are definitely going in the right direction, so long may that continue. And it's come from specialist lenders who are, generally speaking, have kind of some similarities in terms of the way that they're funded. So it's not unsurprising to see that the pricing reductions we've seen across all of these lenders has been very, very similar. So just to kind of wrap these up really quickly, Lend Invest have reduced rates by up to 0.15%. So they've knocked 0.15% off 2-year fixed rates and 0.1% off of 5-year fixed rates. Keystone have wonderfully reduced their entire buy-to-let range by 0.1%. Landbay have dropped their rates by 0.1% as well. So you can see there's a real theme here, which is going to be very much related to their cost of funds. We've also seen Foundation Home Loans issue a new limited edition product, which isn't bad actually. So now their pricing is on 2-year fixed rates starting from 5.89% with a percentage charge arrangement fee of 1.25%. Now, all of these lenders are specialist lenders, to just kind of sort of delve into momentarily the kind of borrowers that these guys attract. So we're looking at individuals with no restrictions around portfolio size. So you can be a first-time landlord, you can be a landlord with 300 properties. These guys can lend to you. You can be a limited company as well. These guys offer mortgages on HMOs and multi-units and various sizes, and they can all do some really interesting stuff. So amongst the kind of range of lenders that we've talked about, so Lend Invest, Landbay, Keystone and Foundation, you've got things like day one remortgages, layered company structures, taking personal guarantees only from company directors, not the shareholders, which a lot of people really favour because it enables them to, the way we see this most commonly used would be that people have shareholding for their children within their limited company. So by not taking personal guarantees from all of the shareholders, this can allow people to have children as shareholders in their business. So I think what to say here really is that, you know what, it could be worse, rates could have gone up, but actually we've seen swap rates, as we've talked about, ease down a little bit. This means that lenders have clearly a little bit of flexibility in terms of been able to drop their pricing down ever so slightly. And I think, you know, let's just hope we continue on this vein, but there's a long way to go before we can say that we're kind of on a real strong downward trajectory now. Now we have seen a little flurry of criteria changes. So before we come on to the rental calculations, which I mentioned at the beginning, Capital Home Loans have made some fairly impressive changes to their criteria. So what they've done first of all, increase the maximum loan on lower loan to values to be up to 2 million at 70% across all products. They're increasing their maximum lending to clients to £5 million with no maximum number of cases. So essentially you can have unlimited number of mortgages with Capital Home Loans. They will lend you up to £5 million. So for those of you who have larger portfolios where you're finding that you're continuously hitting exposure limits with various lenders, Capital Home Loans could be a good solution for you. They've also decided to start lending on the Isle of Wight, and they're going to be lending up to 75% loan to value on new build flats and ex-local authority flats as well, which is really good. So incidentally, not all lenders lend on the Isle of Wight, and some lenders don't lend in particular areas of the Isle of Wight because of concerns about essentially the geology of the island and what's going on there. But actually, so to see CHL moving into that space is fantastic. What I would say here is it's not the majority of lenders who don't lend in that. Most lenders do, but there are a couple who choose not to. In terms of the loan to value increases on new build flats and ex-local authority, again, that's really good. Some lenders do cap their loan to values on new build flats and ex-local authority, so great to see CHL making moves there as well. Now the other lender who's made some changes to criteria, so Metro Bank. So now what they're saying is that, and the big change here is that if you are a portfolio landlord, they can now lend to you if you have up to 10 buy-to-let properties in the background. It used to be 4, but now they're saying 10, which brings them in line with lots of more sort of high street lenders, so your likes of Santander, Coventry Building Society, BM Solutions, those kinds of lenders. Now Metro Bank have also made a change to their rental calculation, which segues us nicely onto that, which is that on 5-year fixed rates, where you're doing a like-for-like remortgage, or as it's also affectionately known in the mortgage industry, a pound-for-pound remortgage, they are now using the pay rate, so the interest rate at which you're going to be paying for the rental calculation. So as an example, if the interest rate you're taking on a 5-year fix was 5%, the rental calculation would be 125 or 145% coverage, assuming an interest rate of 5%. Metro Bank is a high street lender, so no limited companies, HMOs, multi-units, any of that kind of stuff. Capital Home Loans, who we talked about earlier, very much a specialist lender, very, very good at limited company lending, HMOs, multi-units, those kinds of things. Now, continuing with the rental calculations, we've not just seen Metro Bank make changes on their like-for-like remortgage policy, we've seen TSB change their rental calculations. So they've improved things, so essentially on a 5-year fixed rate, they're going to be stressing at the higher of 6% or the product rate plus 1%. So what that means is that if you were taking a 5-year fixed rate of say 5.5%, I'm not saying that's where their pricing is, but theoretically, because 5.5% plus 1% is 6.5%, that's the higher, the rental calculation would be 145 or 125% coverage, assuming an interest rate of 6.5%. The Cumberland are also now stressing their 5-year fixed rates at the pay rate of the product. So they've improved their rental calculation, as have Santander, who are now using a very complicated table actually, but essentially they have improved their rental calculation as well, working across different tax bandings. So for those of you who are basic rate taxpayers, it's 125% coverage. For those of you who are higher or additional rate taxpayers, it's 145% coverage. And then they've got different stress rates as well. So all the lenders, what I think they're doing is they're eyeballing their rental calculation policy. They're saying, well, actually, we think the direction of travel of interest rates is down. Therefore, we can be less onerous and kind of step backwards from the higher rental calculations that we put in place when rates were increasing. Because the reality is that at the end of the 2-year fixed rate, of the 5-year fixed rate, we're expecting interest rates to be lower than where they are now. So if you need a kind of indicator about where people believe the direction of travel for interest rates is, you can probably find it from looking at the way that lenders are treating their rental calculations. Now, in terms of where this leaves us, so I think this is just one to kind of touch on. Now, rental calculations are really, really complicated. Things that impact the rental calculations are your tax code, personal names or limited company ownership, It can be if you've got two applicants where one is a basic rate taxpayer and one is a high rate taxpayer. It can be the property type as well. So HMOs would command a more onerous rental calculation than a standard property because they're naturally expected to be higher yielding and also have higher running costs because of the sort of more regular churn of tenants. So there's lots and lots of things that go into rental calculations, and every lender's is different and it can be different for every single product. So it's quite hard to kind of put a pin in the board and say this is a rental calculation at the moment. But what I wanted to do is give you kind of an example. So at the moment, realistically, if you are an individual, high rate taxpayer looking to borrow some money against a buy-to-let property, the very maximum I think realistically you can get to at the moment is 207 times the monthly rent. So if your monthly rent was £1,000 per month, you could in theory borrow up to £207,000 as long as that meant that the mortgage was no more than 75% of the property value. But more realistically, so where the kind of space is where most lenders are playing in is it's 167 times monthly rent. So if your rent's £1,000, then realistically more lenders are kind of comfortable lending you in the region of £167,000. Now, just to kind of cast our minds back to interest rates going up and where we were, generally speaking, 225 times rent was where things used to be. So I think, you know, if you sort of say, well, typically 225 times rent, now it's 167 times rent, that's where we're kind of finding people getting stuck on things. The good news is that with increasing rents, that has gone some way to mitigate some of the challenges around this. Now, on limited companies, you know, at a real push, 217 times monthly rent. But 185 times monthly rent is kind of more where the market sits more broadly. So that really shows you that if you were commanding rent of £1,000 per month, in your personal name, broadly speaking, £167,000 would be a loan amount. Limited company would be £185,000. And this is one of the reasons why people are using limited companies, particularly on acquisition transactions at the moment because of the more favourable rental calculation. Okay, now moving on to base rate with the MPC meeting tomorrow. It's very, very appropriate that we talk a bit about base rate. Now, the likely outcome from the meeting tomorrow is very much that the anticipated 0.25% reduction will not be forthcoming, I'm afraid, and this is why. So first of all, a June rate cut has essentially been ruled out by Sunak's surprise election announcement. Without an absolutely watertight case for rate cuts, the Bank of England will be sailing close to the wind by starting to ease policy just a few weeks before polling day. Now, the election also provides more substantive reasons to avoid cutting rates. The MPC members have had to cancel their speeches given the ongoing campaign, which makes it difficult for rate setters to prepare the ground for a potential rate cut or explain a decision afterwards. When the rate cut eventually comes, it'll be the first since early 2020. So it's important to explain the thinking for the decision and provide some guidance on what the next moves are likely to be. So it makes a lot of sense to wait longer in purely practical terms, but it's also true that the data since May has not played ball. So since the last MPC meeting, 2 rounds of labour market updates have been released, as well as April's inflation figures. The figures reveal worryingly high levels of inflationary persistence, and we did talk a bit about this, I think it was last week. So annual wage growth is still running at around 6%, which is more than twice the level which is consistent with inflation remaining at 2% target. Likewise, services inflation is still at around 6%, and again, I know we talked about that last week. Now, the two are closely connected because labour costs are the most important driver of prices in the services sector. The bank was expecting to have seen more progress on prices in the services sector by now. In other words, even without the election, there are good reasons why the bank may be unwilling to cut the rates in June, and indeed the markets are increasingly nervy about an August cut, with traders now putting the odds at just 50-50. May's inflation data will be released this morning, just a day before the bank rate decision. More economists expect inflation will fall back to the 2% target for the first time since July 2021. The figures will be crucial for determining whether the bank is on track to cut rates in August, but early indicators are positive. So there you go. So this is why we are not expecting to see a base rate cut in June. So there's kind of two things, actually just the reality of the election being a massive distraction, keeping people very busy, but also actually the reality is that while inflation is coming down, there are certain elements, particularly with regards to labour costs, which are not quite doing what they need to be doing to provide some real kind of certainty that things are finally under full control. As I say, in terms of longer term view for base rates, for those of you who are thinking, well, okay, it will just come down in August instead, We're keeping our fingers crossed for that, but actually, as I mentioned at the moment, the kind of viewpoint is that it's very much a 50-50 as to whether we'll see a reduction in August as well now, so we'll just have to watch this space. Now, very, very interestingly, and just as a kind of reminder, because I know we've talked about this many times in the past, people always associate fixed rates with base rate. The two are not inextricably linked. So a fixed rate mortgage is based on swap rates, broadly speaking, which we've talked about earlier on. And a swap rate is essentially a prediction of what base rate's going to do over the coming 2, 3, 5, 10, 25, 30 years. So when the money markets are pricing fixed rates, they've already factored in what they think is going to happen with base rate. So when the base rate movement actually comes, unless it does something that's totally unexpected, that pricing movement has already been priced in. Which is why actually on the day of movement of base rate, if base rate comes down, we don't suddenly see fixed rates drop as well. The two are not connected. So just a real reminder in terms of how things work. But like I say, I think one of the reasons we've seen swap rates stay very, very sticky over the last few months is because of the nervousness of around exactly the points which we've just discussed. Now here's something I never thought I'd hear myself say. We're going to talk a bit about Nigel Farage. And the reason that I think it's important to do this is just to sort of share some of the points of the Party Manifesto for Reform UK, which came out in the last couple of days. And the reason they're important is actually because they've gone straight in for some points which are very, very poignant for landlords. So the Reform UK Party are going to essentially remove Section 24, which is the taxation that landlords are subject to on personally owned property. On their rents, and they're saying that if they came into power they would remove this within 100 days. So Section 24 essentially removes the landlord's right to deduct the majority of their finance costs, including mortgage interest and arrangement fees, from their rental income before calculating their tax liability. Oh yes, don't we all know that? This means landlords have to pay tax on the gross income that they earn from rental property. So in its contract with you, which is essentially their manifesto, Reform says it will scrap the tax changes for landlords. In the same time frame, he would abolish the Renters Reform Bill and begin a review of the planning system. So the Reform contract with the people, the Farage equivalent of a manifesto, is just 25 pages in its entirety and gives only a small amount of space to 6 general pledges on housing. So the first one is to review the planning system, secondly to reform social housing law, thirdly to scrap the 2019 tax changes for landlords, so Section 24, abolish the Renters Reform Bill, incentivise use of new construction technology, for example, modular construction and smart infrastructure, cut residential stamp duty, just to go into that one momentarily, substantially boost economic activity in house building by cutting stamp duty to 0% below £750,000, cut it to 2% from 750 to 1.5 million, cut it to 4% over 1.5 million. There's no talk about the surcharge here that we pay for second homes and investment properties. And lastly, abolish inheritance tax for all estates under £2 million. Now, no matter how you feel about the Reform Party and Mr Farage, there are some points in here which would certainly appeal to landlords. And I don't think any of us are suddenly expecting Nigel Farage to win the election next month. But I think it does certainly show us that some people in Race for Leadership are actually thinking about landlords in a very different way. And maybe, I guess, what we can really hope for this is this brings some points to the surface in terms of the Labour Party and the Conservatives, and maybe just get them thinking slightly differently about landlords. But let's see. Now, Nigel Farage also is not expecting to become Prime Minister in July, by the way, but what he is doing is kind of building the way for the next election in 5 years' time. And this is the kind of stuff he's going to be building on. So, you know, I think this may not have any immediate impact. It's interesting to see this kind of conversation is now coming to the surface, and maybe, just maybe, this will kind of have an impact on things going forwards in terms of how things shake out for landlords. But, you know, I think I'm probably clasping at straws here. I'm sure you'll agree with me, but interesting nonetheless to see the position that Nigel Farage is taking on the PRS. Okay, and that is really going to be everything for us this week, because I know we're going to be running over. I do have a question of the week outstanding from a few weeks ago, which I do want to answer. And to the person that sent that in, I'm really sorry that we haven't quite got around to that with various election stuff going on and lots of movement on interest rates and that kind of thing, and we've been quite distracted. But actually, I promise I'll come back to you on the question of the week next week, because it is related to an impact of having a Labour government, which is looking increasingly likely, in terms of how that will impact certain things with regards to mortgages. So I will be coming back to you on that one. So all that's left for me to say for now is have a wonderful week. And as always, if you did want to contact us, please do feel free. We'd love to hear from you. 0345 345 6788. The weather is looking absolutely beautiful this week, so I do hope you get a chance to get out and enjoy some of it. The longest day is upon us, I think, very, very soon. So we'll soon be talking about Christmas. I've said it, it's out now. Do look after yourselves, and I'll see you same time next week.